So first, let's talk about accounting profits and economic profits. Here's what they have in common. They're both just revenues minus costs. That's what profits really is, right? Now, accounting profits is what you think about in the real world, right? So let's look at a specific scenario. Let's say you're graduating from college, you have a job offer for $50,000, but instead you decided to start your own business. Now, in that business, let's say if you were to work for the year, you would make $100,000 in revenues, and you would have a $40,000 operating cost. So that means cost for paying rent, paying your employees, all that jazz. So here's a question. What are your profits? If you were to ask an accountant, what are your profits? What would they say? Well, they would say that you made $60,000 because, hey, you made 100 in revenues, you spent 40 of it, so you came home with 60,000. But if you were to ask an economist, what are your profits? They would say that, well, yeah, sure, you made 100,000, but your total costs are not just the operating costs, but also the opportunity cost. So if you recall what opportunity cost is, that's the value of your alternative. See, by running your business for the whole year, what you're giving up on is the $50,000 you could have earned, right? So that's kind of a cost. You're giving that up by spending the time running your business. So an economist would say that your profits are only $10,000. So if we wanted to come up with formulas for these, we would say that the accounting profits, 1 point on notation, pi, no relation to 3.14. In economics, it's a pretty common thing to use pi for profits. You might think, why not just use P? Well, we're already using P for price, right? So that's why. So accounting profits really are just your total revenues minus just the physical costs. That's also called explicit costs. Explicit costs. So that's anything that you physically pay versus your economic profits are your revenues minus your total costs. So one way to think about it is it's minus the explicit costs, but also minus the implicit or opportunity costs. So that's the thing. If you think about it, if you wanted to even relate them further, notice that what they have in common is that they're both revenues, what you bring in, minus your physical costs, right? That's your accounting profit. Economic profits just go one step further. So you can even say that your economic profits are equal to your accounting profits, but then you also have to subtract the implicit costs or opportunity costs. So that's why if you think about it, your economic profits, you could have said, well, you made 60,000 physically in profits, but you kind of gave up the 50, and that's how we got the 10. Now, let's look at what would happen in the same scenario if your operating costs were actually 50,000. Now, in that case, if we want to know what our accounting profits are, well, 100,000 in revenues minus the 50,000 in operating costs, so that's $50,000. And now if you were to look at your economic profit, well, it's the accounting profit minus the opportunity cost, so minus the 50,000 that you're giving up. But 50 minus 50 is 0. So, what does that mean if you have 0 economic profits? Does that mean you're starving? Well, clearly not, because your accountant's telling you that you made $50,000 that year. So here's what economic profit really means practically in the real world. It's basically saying how much more, or less if it's negative, you're making by running your business compared to your job. So if your economic profit is 0, that just means you're not doing any better or worse than if you had a job and you were making $50,000. So that's the thing. One big conclusion we'll come to in the next module and a couple modules later is that all firms in the long run make a 0 economic profit. But that doesn't mean they're starving. That just means every business owner, on average, in the long run, will make about the same as if they would have had a job instead. Now, let's finally kind of look at what would happen in this case if your operating costs were 70,000. Well, in that case, your accounting profit would be 100 minus 70, so it'd be 30,000. And your economic profits, though, would be the 30,000 that you physically made, 100 minus 70, but minus the $50,000 opportunity cost, so that's negative 20,000. So again, If you have a negative $20,000 economic profit, that doesn't mean that you have to take a loan or that you're in debt or anything like that. But that just means that you made $20,000 less than if you were to have a job. Because, hey, you made $30,000 that year, which is just 20 less than if you were to have a job instead.